Good evening, class, and welcome to our taxation class. Today, we are going to be discussing withholding tax, also known as WHT. What are some of the learning objectives we are going to find out here? We will know the nature, objectives, and administration of withholding tax. We'll look at the relevant tax authority for the collection of withholding tax. Then we are going to look at transactions that are subject to withholding tax. Then we look at those that are exempted and what are the applicable rates. Then we will look at something called exemption of sales in the ordinary course of business from withholding tax, taking into consideration the judgment of Tax Appeal Tribunal held in Lagos, November 30, 2020. Look at the procedure for filing withholding taxes, the treatment of withholding tax receipts, credit notes, procedure for return for relating to withholding tax refunds, merit and demerits, penalties, and so forth. All right, so what is withholding tax? Withholding tax is a tax deducted at source from payments made to a taxable person for the supply of goods and services. So someone is deducting another person's money from source. So what it means is that if I am the taxing agent and you are the receiver of this money, instead of me giving you your full money, let's say I'm supposed to give you 10,000 naira, instead of giving you the full 10,000 naira, I am deducting from that source. So you call deduction from source. You are expecting 10,000 naira. What you are getting is less than 10,000. What is out is the withholding tax. So who is the taxpayer here? It is the person who receives the money less withholding tax. It is the person who suffers withholding tax. So withholding tax is suffered by someone who receives money from another person. So it means that that money you are receiving is the source, and they deduct it straight from that source before paying you the net. So you'll be hearing things like net of withholding tax, meaning that from that source, which is the gross, an amount called the withholding tax has been removed, leaving you the net. Withholding tax is not another form of tax. Rather, it is an advance payment of tax. Withholding tax is not another form of tax, but an advance payment of tax. As the withholding tax is deducted from source, it is used to set off any tax liability that will be due to the income. So what it means is that if the taxable person who suffers withholding tax is a person, withholding tax is an advance payment of his personal income tax. It's not a new tax. It's just an advance payment. If the taxable person is a company, withholding tax is an advance payment of his company income tax. In certain cases, the withholding tax deducted at source is the final tax in the hands of the recipient. What it means is this: withholding tax is supposed to be an advance of your tax, meaning that you are supposed to prepare personal income tax at the end of the year. But before that time, the government has collected withholding tax in advance. Now we are saying that for some people, this withholding tax that is supposed to be an advance payment is also a final payment, meaning that they don't need to prepare personal income tax, or they don't need to prepare company income tax or petroleum profit tax. No, that withholding tax is final tax in the hands of some cases of people, not in all cases. But in majority of the cases, withholding tax is an advance tax. Section 81 of the Company Income Tax Act, as amended by the Finance Act 2021, provides that income tax assessable on any company, whether or not an assessment has been made, shall, if the service so direct, be receivable from payments made by any person to such a company. So, any such direction may apply to any person or class of persons specified in such direction, either with respect to all companies or a company or class of company liable to the payment of income tax. I will need to be summarizing this long law legal statement. What it means here is that you are supposed to be liable to tax, withholding tax from your assessable income. So your assessable income is liable to tax. And so your withholding tax is an advance collection of tax from that assessable income. We'll go speedily further. A taxpayer, peculiarities of withholding tax. What are those things that are peculiar to withholding tax, which is different from other taxes, like company income tax? Here it says here, a taxpayer has no option as to whether to pay withholding tax or not, as the person who is making the payment is required by law to deduct. So it means that if you are having transactions with me and that transaction requires withholding tax and I'm supposed to pay you, the law says that before paying you, I have to deduct withholding tax. So you have no option than to suffer it. Failure for me to deduct before giving you the net attract sanctions on me. So I wouldn't want sanctions to come to me. I would rather follow the law and you will suffer the withholding tax. That's it. Another peculiarity is that it's an advance payment of income tax and can be utilized as tax credit against income tax liability of the year of assessment to which that income relates. So let's say, let me give you this example now. You want to buy clothes, right? And let's say the clothes is 50,000 naira. And you decide to pay 20,000 naira advance payment. And they give you a kind of receipt or acknowledgement, yes, a receipt. to show that, or a note to show that you've paid part. On the day that you are paying the whole money and collecting the clothes, you will not be paying 50,000 anymore. What you'll be doing is you'll be paying the difference called 30,000. Why? Because you have a note in your hand saying you have already paid 20,000 and I'm paying the difference. So that's how withholding tax works. Withholding tax is like the advance payment, and you have a note showing that you've made an advance. When you now prepare your complete tax, you are to deduct the withholding tax. Your evidence is the withholding tax credit note, which you will use to set off the tax liability. Now, for some people, withholding tax may be their final tax. We are going to see some of those cases. What are some of the objectives of withholding tax? One is to discourage or minimize or prevent the incidence of tax evasion. So you see here, some people run away from tax. Anything tax, they run away. I don't want to register my business because of tax, they run away. I don't want to register in tax pro max, they run away. I don't want to register in Lagos State Internal Revenue, they run away. Are you run away from withholding tax? The law says that somebody who is paying you must deduct withholding tax. And so because it deducts it by law, it has made you pay tax one way or the other. So it has minimized that you are running away. That running away that you are running, it has minimized it in the sense that at least you pay withholding tax. Secondly, it increased the tax net of the government. Okay, so when you are paying, when you are suffering withholding tax, the person who removed that withholding tax would have collected your name, your phone number, and as he is remitting these things to the government, he is putting your name, your phone number, your email. Government is taking these things to build their data, and you are now in the tax net. When the government now checks this phone number, this email, it belongs to a particular BVN, it belongs to a particular person. This person does not have tax ID. You can create a tax ID for this person. Government is putting you into the tax net. Then it can serve as a veritable source of revenue to the government. So it means that government does not have to wait to collect a tax from you once a year. Government is saying that at periodic times, please be paying this advance of your income small. Let's say every month, you are paying these things every month. Government will have at least 1/4 or so, 1/4 or 1/3 of your money that you are supposed to pay at the end of the year. Government would have gotten like 1/3 of it and use it for administrative purposes, serve as revenue. And so, if government collects 1/3 of something that they are supposed to collect eventually, even if you don't pay tax, government has collected their slice, the minimum slice, which is the 1/3. And so it has prevented tax evasion. You are in government net, government has gotten source of revenue. And it serves as a collection mechanism for income tax. So because you pay withholding tax, you are likely to go and file your income tax so that you will take your withholding tax credit notes and reduce that tax. That means you are now, paying your income tax. Government has used that withholding tax to prompt you to file your withholding tax, to file your income tax. Now, the administration of withholding tax. The authority to withhold tax at source is vested on the Federal Inland Revenue and the State Internal Revenue. Now, the tax provision deals with deduction, like the tax provision in the Company Income Tax Act deals with withholding tax deduction from rent, royalties, interest, dividends, directors' fees, and other payments. Okay, so directors' fees is for only personal income tax. Directors' fees is for only personal income tax. And every others, both personal income tax and company income tax, they deduct withholding tax from rent, royalties, dividends, and other payments, as you will see. The relevant tax authorities, we said it is the Federal Inland Revenue and the State Internal Revenue. So, how do you know who to pay to? You ask yourself, who suffers the withholding tax? If the sufferer is a company, that means the person who deducted it should remit it to the FIRS. If the sufferer is an individual, the person who deducts it should pay it to the individual's tax authority covering its jurisdiction. So take note, it is not the tax authority of the individual deducting it. It is the tax authority of the individual who suffers the tax that matters. Take, for example, Go Getter Professional Consult. Let's say it's a limited company. Let's assume it's a limited company. And it deducts tax. Okay, let me use another one. Let me use another example. Let's say FCA Limited deducts tax, withholding tax from Go Getter Enterprise. Go Getter Enterprise is under Lagos State Government. FCA Limited is under FIRS. Who deducts is FCA. Now, who suffers is Go Getter. So that means the State Internal Revenue is the taxing authority for Go Getter. So FCA will file under Lagos State Internal Revenue on behalf of Go Getter, so that this withholding tax credit note can be given to Go Getter, so that when he is filing his tax, he can reduce it. Now, assuming it is Go Getter that deducts from FCA Limited, and perhaps Go Getter also deducts from Mr. Chima. These are two different people. FCA Limited is a company. Go Getter will file FCA's withholding tax in FIRS, because FCA is a company that will file with FIRS. While Go Getter will file Mr. Chima's tax, perhaps in Lagos State where he is based, because it's an enterprise, it's a person. So you see here, it is who suffers that determines the tax authority. Now, if individuals are living in the FCT, there is a tax authority called FCTIROS. These ones are responsible for citizens of FCT. Now, what are those transactions and the applicable rates? Let's look at this. We have A, B, C down to L. Now, I will do something now. When we were doing investment income, we discussed royalties, rent, interest, and dividend. Now, can you see something common among them? Apart from royalties, apart from royalties, what is common among them is that these are investment income. Investment income. Can you see that the rates are the same? 10%, both individual and company, except for royalty that is 5%, company 10%. Then when we come to directors' fees, now if you look at these things now, directors' fees, consultancy fees, management fees, technical fees, those ones that have fees. Let me say from here, all these ones are fees. For directors' fees, it's 5%. Company is dash. So can you see here? They're all 5% for company, for individuals. For company, they're all 10%. So can you see the difference? Why I say this is dash is that a company cannot be a director. A director must be a person. So this is not available for dash. This is 5%. Now, if you look at this one, construction income is the same for individual and company, either 2.5 or 5, as the case may be. Then if you look at agency arrangements, agency arrangements, still part of the fees. Then contract of supply, this is 5%. This is 5%. Contract of supply, 5% for both companies and individuals. So what will happen is that you need to learn, you need to find the updated, let's find the updated withholding tax. Okay, if you look for the withholding tax rates, it would have been updated because in 2024, the the presidential committee um, prepared an updated withholding tax that covers a whole lot, but that will not be tested in the exam. That will not be tested in the exam because it has not been approved. It has not been approved, so that will not be tested. Let me check here for Nigeria. All right, so this is what I've been saying. This is the updated now. So this is our withholding tax for company and for individuals. So the directors cannot be uh, a company. So these are dividends, interest, and rents. These are investment income, they are 10%. All the fees, apart from director's fees, they are all 10% for, okay, this is 10% for director individual. Apart from that, all other fees are 5%. 5% for individuals, 10% for company. Look at road and construction. It is 2.5% for company, but 5% for individual. So we need to copy this one out. Let's copy it out. So you will get it as, let's copy this one out. Yes, got it out for you. All right, so I think I'll need to adjust this. This is 10%. As we have seen, this is 10%, so we'll leave it that way. Then we have also seen here that this is for individual is 5%, and this is correct. So I cancel this here, and cancel this. All right, so they say the term contract covers all forms of supplies. Contract of supply, sorry, covers all forms of supplies, delivery, or the like through competitive bidding tenders, LPO, or other arrangements, whether written or oral. So it means that if you bid for a contract to supply goods, you bid and you are given pro forma invoice, other arrangements, whether somebody tells you, okay, please, orally, I want you to be supplying me maybe tissue paper or bottled water. That means there is a kind of understanding, a kind of binding contract. It is not whether you write it or not, but whether it is an understanding that exists orally or written. There is a contract. That contract of supply covers them all. Whether you're a company or an individual, you are liable to suffer 5% withholding tax when you deliver on your contract. Now, they say this term does not cover across the counter cash sales or supplies in the ordinary course of sale. What does it mean? You come to my shop, even though you are my customer, you come to my shop and you say, how much am I selling television? I told you the price, and you pay me over the counter, and you go to and you go your way. That is over the counter cash. You won't be deducting withholding tax from me because this is not a contract. It is different from, please bring it to my office and be bringing this for me regularly. Or I will come and collect it and I'll be collecting it regularly. That's a contract. So the fact that I deliver it to your office does not mean it's a contract. That is a delivery service. That is sales in the ordinary course or supply in the ordinary course of sale. You could have gone to any other place to go and do it. You are not having the intention that I have somebody who is supplying me. If you say I have somebody who is supplying me, that means there's a contract. But if you are free to go anywhere and just go and buy, that is in the open market. Sales in the ordinary course of business doesn't apply. Then the withholding tax rate of 2.5 on construction contracts applies to construction of roads, bridges, building and power plants, and all that. Now look at the exemption. Exemption of sales in the ordinary course of business from withholding tax. They said on November 30, 2020, the Tax Appeal Tribunal sitting in Lagos Zone, in the case of Tetra Pak West African Limited versus Federal Inland Revenue Service, ruled that sales in the ordinary course of business shall not be liable to withholding tax. The Tax Appeal Tribunal laid the following criteria in ascertaining what constitutes sales in the ordinary course of business. One, the inclusion of the transaction or activity in the object of the memorandum of association. So it means that if this my transaction or my activity is in my memorandum of association and you come to buy from me, that is my normal thing I am selling. It is in the ordinary course of business. Two, the nature and practice of the taxpayer's business and industry. And we also have the history of the taxpayer in relation to the activity. And finally, the frequency of the type of transaction. So it means that you bought tissue paper, one carton from me today, then you come again and you buy another one carton from me. I am now your customer. You can always tell me, please, oh, can you supply me? So you see there is a frequency before you now make it. It's no longer in the ordinary course of business. At this point now, you can even owe me, right? Because I'm now supplying, you can say, okay, I will pay you later. That kind of understanding can only come from contracts that is not in the ordinary course of business. Procedure for filing withholding tax. It is expected that a schedule of withholding tax payable should be prepared by applying the correct withholding tax rate on each transaction or payment made during the month. So what it means here is you create a schedule, you you start with the taxpayer's name, you start with the nature of transaction. Okay, so look at what we are saying here. You prepare a schedule. Let's see how that schedule will be. This is topic. Withholding tax. WHT. So now you are making a withholding tax schedule. So this is your withholding tax schedule. So this is like serial number, tax payer's name. Then you can come with ROC or BN number. You now have their team. Then you have nature, nature of transaction, right? Gross amount, withholding tax rates, withholding tax amount, net amount. So these are the example of the schedule that you are preparing. Okay, so let's see how you fill this schedule, because you may be asked in the exam to prepare something like this. And so this is number one. The taxpayer would be go getter professional consult. So this is an individual. So the ROC number should be, let's say, BN 123. Then the team is 1234.0001. Nature of transaction, let's say this is contract of supply, or for supply. Gross amount would be 100,000. Withholding tax rate is 5%. Withholding tax amount would be 5,000 naira from 100. The net amount will be 100 minus 5 will be 95. So it means that it is this 95 that you are paying go getter after he has supplied you the goods. This 5,000 has been deducted from this source. 95,000 is received. Then you now say the next person now be FC Limited, and it is RC, let's say 456. In 15 will now be, let's say, 789-0001. Maybe it's management fees, and you are paying 200,000. They supplied you management fee and you are paying them 200,000. Withholding tax is 10%. So you remove 20,000 from it and you give them 180,000. This is the kind of schedule that you are to prepare every month. Every month. All right. They said it is expected that a schedule of withholding tax payable. So this is the withholding tax payable. This withholding tax amount, the withholding tax payable, should be prepared by applying the correct withholding tax rate on each transaction or payment during the month. Thereafter, a check for the amount due to the FIRS is raised and forwarded plus the withholding tax schedule in soft and hard copies. So in this case now, You are going to do two schedules. You are going to do two schedules. One of them must have only companies' names. Must have only companies' names. And when you do that, the total withholding tax is payable to FRS. The second one will contain only businesses that are not companies. And you need to identify their tax authority and pay the relevant tax authority their withholding taxes due to them. Now, the withholding tax is then uploaded into the FRS portal. Once accepted, an electronic receipt is generated as acknowledgement that the process is successful. Thereafter, the bank submits copies of the withholding tax schedule and evidence of payment at the local FRS office for processing of both the bulk receipts and individual receipts. Now look at the contents of withholding tax returns, like how the payment schedule, like I drew up there, the name of the taxpayer who suffered the deduction. In this case here, we have GGPC and FCA. The nature of the activities and service rendered and periods covered. Okay, the periods covered is what is missing here. So we can put one of them with the date of transaction. Okay. The next one is their tax file number, which is now known as tax identification number TIN. There is a TIN here. Then the total amount payable, which is this gross amount. The rate of tax applied, which is the withholding tax rate. The amount of tax withheld, which is the withholding tax amount. The balance paid to the taxpayer, which is the net amount. The tax contract for which the returns are being made, which is the nature of transaction. The due date of payment and the check number and date, these are not there. So it means it's a long kind of schedule that you are making. Most times it's done using Excel. Treatment of withholding tax credit notes. When payment is made to the bank or the withholding tax section of the revenue in respect of withholding tax deducted at source, the Federal Inland Revenue will issue credit notes in favor of the taxpayers whose names are contained in the tax schedule. So when you have paid and you submitted this schedule, the FRS will issue a withholding tax credit note on GGPC's name in respect of 5,000, on FCA Limited in respect of 20,000. Of course, this GGPC is not for FRS, it's for the state internal revenue. FRS is for only companies. All right? The credit notes are to be forwarded by the collecting agent. Now, who prepares this schedule? Let's say it's Marianne that prepares this schedule. Marianne is now the collecting agent. As you file and you pay, FRS will provide withholding tax credit note and send to you, Marianne, who you will now forward to these tax payers so that they can use it to claim credits on their tax liability. It is important to emphasize that a presentation of letter from the collecting agent showing that taxpayer has suffered deduction is not enough for FRS to grant withholding tax credit. All that is going to change, but for now, it has not changed. We follow this. Now, similarly, government treasury receipts issued by other government departments showing that they have deducted tax from a taxpayer is not enough to grant tax credit, since only the FRS can collect tax for the government. So what they are telling you is that if you have a covering letter, it is not enough. What will be enough is when you have your withholding tax credit note. That is only what is required. What are some of the merits and demerits of withholding tax scheme? One of the merits is it serves as a source of revenue to government. Two, it brings people into the tax net, those who were previously unknown. So because they suffer withholding tax, they are now in the tax net. Three, it helps in determining somebody's turnover. For example, if you are always dealing on transactions that has to do with withholding tax, it is a way of determining your turnover. So sometimes some people will pay withholding tax and they don't know that they have paid up to a particular amount. They now went to give a lower turnover. There is a way the tax office will know what your turnover is from your withholding tax. It makes tax payment less cumbersome to the taxpayer, who may not have to bother himself going to the tax office to pay his tax. So because you are collecting his tax on in his behalf and you are paying it, it is a kind of relief from stress. It reduces tax evasion. It involves little or no costs because it is self-accounting, and it saves time for the revenue officers to attend to other duties. What are some of the demerits? A high rate of withholding tax is likely to affect operational performance. Operational performance. Application of withholding tax affects cash flow of most businesses because they now receive less than what they have estimated for or put in their budget. And it is likely to discourage hard work by revenue officers because it is self-accounting. What is the penalty? Now, the tax law says that withholding tax is supposed to be filed and paid within 21 days from the date the amount was deducted or the time the duty to deduct arose. So normally we usually say the duty to deduct the withholding tax. Most times, most people put it at the end of the month. Of course, you may want to, if somebody buys goods for you at the first day of the month, the duty to deduct this tax arise. But cumulatively for the whole month, the duty to deduct withholding tax for all your transactions in the month is at the end of the month. And so 21 days from that, which is 21 day of the next month, you are supposed to file and pay. Any taxpayer or collection agent that refuses to deduct, file, and pay is guilty, and you will be liable to pay 10% of the amount that is of the tax that is withheld and not remitted. So it means that if you withhold, let's say, Marianne, you are the collecting agent, you withhold withholding tax, and you fail to file and remit. 10% penalty is attracted on that amount. So you withhold 20,000, you pay additional 10% of it, as the case may be. Now, similarly, failure to deduct, and having deduct, failure to remit to the state board within 30 days, you shall be guilty of an offence and be liable to a fine of 5%, 5,000 naira, in addition to the tax deducted but not remitted, plus interest at the commercial lending rate. Right? Now look at these notes. Withholding tax deduction from payments due to companies. So take note here, the key words here. Payments due to companies. That means if you are paying to companies, the withholding tax from this kind of payments are payable to the FIROS. Withholding tax deduction from payments due to individual are payable to the state internal revenue. Third one, withholding tax deduction are payable from to the Federal Inland Revenue Service, where the payments are due to the residents of the members of the Nigerian Armed Forces, police officers, Nigerian Foreign Service, and persons outside Nigeria. For those who live in Abuja, with effect from 2015, there is FCTIROS responsible for collection of withholding tax from non-residents and residents of Abuja. So it means that those who reside outside of Nigeria fall under non-residents and then residents of Abuja. Withholding tax on dividends. So now look at this one. Withholding tax on dividends, interest, rent, and royalty when suffered by non-residents. So these are investment income. Withholding tax on investment income suffered by non-residents represent final tax in their hands. Why? Because they are not paying income tax to Nigeria. They are not having employment income there. They are not doing any trade. They are only doing investment. So this investment income, the withholding tax on them is the final tax. And now they said from effect from January 1996, withholding tax on interest and dividends is final tax for individuals. So anybody who is doing dividend, who gives out money and buy shares and you pay dividend, you receive dividend, the withholding tax on it is final. You lend money and they are paying you interest, the withholding tax on it is final. Now that we've done that, let's look at some example here. Let's look at this question here. We are told that Adebola Nigeria Limited has been trading for many years. The company makes up its accounts to December 31st annually. The extract from the statement of profit or loss for the year ended 31st December 2012 and 2013 as adjusted for tax purposes are as follows. Look at 2012 year of assessment. Look at okay, these are account ended 2012 2012 and 2013. Okay, look at the trading and profit adjustments. Bank interest received, debenture interest received, they're all gross, gross, gross. Dividends received from Adesemowo Limited net. Dividend paid to shareholder gross. Okay, now we are told to compute the company's tax liability for the relevant years of assessment, and we are told to ignore capital allowance. So this is it. This is the solution here. Okay, so let's look at how it was done here. Let's see how it was done here. That trading profit that you are given, it was given trading profit adjusted. It's the same figure that we have here and we have there. Bank interest was gross, yes. Debenture interest received was gross. So these are all the gross income received. So your total income or accessible profit will be all of those excluding dividend income. Why? Because dividend income is, we said before, is a frank investment income. It will not be subjected to tax. So your total profit or accessible profit will be the sum of 1, 2, 3. Then you look for 30% of that, of this accessible profit. Then you look for tertiary education tax, 2% of this accessible profit. You do that for the different years. Remember, there was 2013 there and 2012. So when you are doing your solution, you use the year of assessment because we are using preceding year basis. Preceding year basis. So we have 2013 December 31st. That's the end of the accounting date. The year of assessment will be 2014. That's why we have 2014 here. Okay, so I think I should open another instance of this here so that we can see how question and solution goes. Okay, so this question is also saying that, okay, so what we did now, this is the 2013 basis period ending 2013. Year of assessment should be 2014. Yeah, year of assessment should be 2013. So is this trading profit and loss? Okay, so is this figure, this, this, and this that was used here, that was used here. So this is it here. So that's the figure. They are all given as gross. So we take them as it is. Now we are told determine the net withholding tax payable or receivable by Debola Limited arising from the dividends paid by it. So if you look at this thing here, dividends received is an income. Now they received net because there is a duty to remove withholding tax. But when you are going to record it, you are going to record it at gross. So convert to gross. How do you convert to gross? By multiplying it by 100 over 90. So what it means here is 720 times 100 over 90 to now become gross. So how do we do it? Let's do that. 720 times 100% divided by 90, because net is 90, because they are taking 10%. That's why it is 90. So that means the gross is 800,000. 800,000. That's what we find here. That's what we find here. So you have seen it here. That's the calculation they did here. 800,000. That is the gross. That means 10% was withdrawn, which is 80,000. Right? Then we are told that 6 million was paid. So you see here that 800,000 was deducted. 800,000 was the gross, right? And we see that 10% was deducted. That's for the first one. Then we are told that okay, so 800, 800. Then we have withholding tax on dividends paid. 6 4 10% of 400 4 million, 10% of okay. So what they are saying is that you paid, where's the question again? You paid 6 million, you paid 4 million. So what it means is this. This is what you've collected. You've collected 80,000 because of the 10%. And you also this is what you suffered. Sorry, this is what you suffered. This is what you suffered. You say suffered because you were the one that received 800,000. So they deducted this 80%, 10% from you. So this 80,000 was what you suffered. When you were paying this 4 million, you received 400,000. So this is received. So what happened? 400K is received, 80K is suffered. The balance is 320K is what you remit to the government. The same thing applicable here. You collected 600K and you suffered 80K. So 520K is remitted. So that's it. Then there is another question here. Cuba Limited, a medium-scale manufacturing company, made the following transactions during the year. Now, let's look at this transaction. 250,000 was paid to Mr. Okon, an estate surveyor, for the services rendered during the month. How is it treated? Okay, what are we asked to look for? Required. Compute the withholding tax payable to FROS. So let's check Mr. Okon. This Mr. Okon, this is state. I'll call it SDIR. 650,000 was paid to Amani Limited. is FIRS. 800,000 was paid as interim dividends to individual, this is state. 18 million was paid to Mainland Limited for purchases of goods, so this is FIRS. 360,000 was paid to a management consultant, this is SBIRS. 1 million was paid to Cassie Limited as royalty, is FIRS. And here, directors of the company, this is individual, SBIRS. So the first one, we said this is 11th of April. So 11th of April, this FIRS here, this 650 for technical services, you need to remove 10%. So that's what is done here. 10% is charged out of this 650, and so 65,000 was remitted to the government. Then the next one for FROS is 19th of July. Okay, it's not here. Okay, so was paid to Binland Limited for purchases. Okay, this is ordinary course of business. I didn't see that. Ordinary course of business. So in the ordinary course of business, no withholding tax. Then we also have here November 26. Let's see. November 26, Cassie Limited. So Cassie Limited royalty. Royalty is 10%. Let me put the percentage here. 10%. This is also 10%. Royalty is 1 million, 10%, 100,000. So 165,000 is what you are paying to the FRS. Then to the state, we have February 7th. Yes, Mr. Okon. February 7th. How much was it? Estate, this is surveyor's fees. That's 5%. So 5% of 250, that gives me 12,500. Then we also have payment to individuals on May 15th, 800,000. Dividends, 800,000. Dividends, which is this. Yeah, we have done this, we've done this. Dividend is 10%, yes. So you deduct 80,000. The next one here, Pedro, a management consultant, is another individual, is 5%. Management consultancy. Management consultancy, you pay 5%. Then we have director's fees. Director's fees is 10%. So that's what we have here, 10%. So the state internal revenue. So that's it. That's how we come to the end of our class on withholding tax. In the next class, we are going to be looking at value added tax and see how value added tax also supplement or complement this topic of withholding tax, because these two topics go hand in hand. So when we've done that, we would have taken a great stride in achieving something in our taxation class. Sometimes people confuse withholding tax, and VAT. So when we take this class, we'll be able to see how we bridge that gap. So thank you so much for coming to class, and we'll see you again in the next class when we'll be taking a new topic called value added tax.